Hi, my name is Arturo Ramontes, and I am a senior mortgage advisor for Amerifund Home Loans. Today we're going to go over the process for buying a home. Okay, so where do you start? What step do you take first? Let's go over those. So we're going to go over the steps in a brief overview, and then we're going to get into each one with more detail. So the first step you're going to do is you're going to want to get a pre-qualification. Then you go shopping for homes, submit an offer, you negotiate. You get the contract accepted and you open escrow. You order the home inspection or you can waive it. The file goes into underwriting. You order the appraisal. Underwriting is complete. The appraisal report comes back as is and at value. The loan is clear to close. We call that CTC for short. Then signing can be scheduled with the escrow company. After you sign, the loan funds. After the loan funds, the deed gets recorded with the county and you are the owner. Once you're officially the owner, you get the keys. So, pre-qualification, how do you qualify? Here are some of the key factors. Debt to income is a big factor. Then you have credit score. We use the mid score. Essentially, it's the middle score. Overall, 24-month credit history. You look at assets. It's basically your money available for closing, right? Your down payment or your closing costs. And then we look at a minimum employment and resident history of 2 years. This doesn't necessarily mean that you have to work in the same company for the 2 years straight. We're looking for history. Now, if you have multiple jobs with the same company, obviously that shows a lot more stability. But please, don't let that get you worried, and don't let that think that you're not going to qualify. There's several rules, there's several guidelines that still allow you to work, even if you've had different jobs throughout those 2 years, different jobs in the past, and even if there's some employment gaps. And please get with me, your loan officer, and we can discuss those options. We can get into those, what those are in detail. Now, what is debt to income? So there's two debt to income ratios that the underwriters look at to determine your ability to repay the loan. It's basically, one is called the front end ratio, the other is the back end ratio. The front end ratio would be your potential new mortgage payment, right? So after we've crunched some numbers and put some stuff together, if your new mortgage payment is going to be $1,500 or $1,600, and that's your potential new mortgage payment. And then we just look at your gross monthly income in comparison to that. The other one is your back end ratio. So not only do we look at the potential new mortgage payment of what your new house payment is going to be, but in addition to all your other financial liabilities, and then we compare that against your gross monthly income. Here's an example. So we're just say if the gross monthly income is $6,250, that's how much you make every month, and your potential mortgage payment, so the home you're applying for, if it's going to be $1,695, right? And then altogether, your other financial liabilities, that could be your car payment, your credit cards, all that stuff together. So your minimum monthly liabilities are $880. So with this example, your front end, we're only comparing just the potential new mortgage payment and your gross monthly income. When you divide those together, you get 27.12%. Your back end is at 41.2%, right? So that would be the $1,695 plus the $880, and then we compare that to the gross monthly income. Now, in this example, if your gross monthly income is only $3,500 and the potential mortgage payment is $1,895, and let's say you just have one simple car payment of $350, then your front end is at 54.14% and your back end is at 64%. In this example, you do not qualify. Each loan has different criteria for score and debt to income. Let's take a look at credit score. Right, so we all know credit scores. We have Experian, we have Equifax, we have TransUnion. They range from 300 to 850. So there's different minimum requirements based on the different loan products that are out there. So conventional has a minimum credit score of 620. Now this may surprise you. FHA has no minimum score required. We can actually do a loan if you have no credit. If you have no credit score, you can still purchase a home through FHA. Okay. Now there's a difference between having no credit and having bad credit. We can get into that in detail. There is a difference. Now, anytime that there is no score, you can see that the government loans, so VA, The VA loan for the Veterans Administration, also has no score required. USDA loan, those are for rural areas. Those also don't have a credit score required. Now, that doesn't mean that you can just get approved. They do look at, like I said earlier, a 24-month overall credit history. Well, what credit if I have no credit? You're right. So at this point, what we're looking for is we're going to look for alternative trade lines, right? We're going to ask for at least 3 to 4 accounts that are in your name, that you do have a good payment history. So for example, most people have car insurance. A lot of people have cell phones. As long as the phone bill is in your name, or a lot of people have utilities, right? So your utility bills, gas bill, water bill. So as long as you have at least 3 accounts and you have 12-month history or more of on-time payments, then we would be able to apply for basically a no score loan. Okay? Now, for mortgage purposes, we use the mid score. That's the middle score between all 3 bureaus, regardless of the order. So if we look at this example, we have Experian at 740, Equifax at 720, and TransUnion at 780. Your mid score is going to be 740, right? So we take the highest score, the lowest score, we move those aside, and we use the mid score. Now, in cases where there are multiple applicants, so let's say you're applying together with your spouse, it's going to be the same. You can put up to 4 people on the application. So whoever's on the application, we're going to get the mid score for each one, right? And then it's going to be the lower of the 2 scores, right? So if you have 2 people and one of the mid scores is 740 and the other mid score is 720, then we're going to use 720 as the qualifying score. It's always mid score first and then lower of the 2, or lower of all the applicants. Now, assets, down payment, cash to close, reserves. What does all this mean? Right? So on a conventional loan, the minimum down payment required is 3 to 5%. 3% if you're a first-time home buyer. If you already own a home and you want to upgrade or you want to downgrade and you're going to buy another home, typically the down payment is 5% because you're no longer a first-time home buyer. Now, there are programs that will allow you to still put 3% down, but they do have income limitations, right? And it's typically about 80% of what's called the average area income in the area you're looking at. FHA is going to be a 3.5% down or 10%. Now, here's the difference. If you are a 580 score or above, you're allowed to put the 3.5% down. If you are at 579 score or below, then FHA at that point requires 10% down, right? So remember when we talked about the loan that does not require a credit score, okay? There's a difference between having no credit and having bad credit. This is kind of where that comes in. So on the no score loans, just because you don't have a score, you can still do the 3.5% down, okay? Now, when you have the score, typically if a score is generated and it's in the lower side, it's because there's either some collections or something going on there, some late payments. So therefore, the 579 would require a 10% down. Now, the VA loans do not have a down payment requirement. They offer 100% financing. Now, that does mean that there won't be any cash to close, right? You still have closing costs. So we're talking about the down payment. They're going to finance 100% of the loan, not 103%, right? So the closing costs won't fit into it. Same thing with USDA. Those are specifically for rural areas, and those are real specific. Not just the buyer, but that home, that property where it's located needs to qualify for that USDA loan. Okay, so let's just say the purchase price is $350,000, and in this case, we're just going to say the closing costs are $6,000. We're just using those numbers as an example, right? So the conventional down payment, the 3% would be $10,500. If it was 5%, now you're at $17,500. If you were doing an FHA loan at a purchase price of $350,000, your FHA down payment will be $12,250 if you're able to use a 3.5% down. If you had to put 10% down, again, you still get that FHA loan, but now you're talking about $35,000. And again, VA and USDA do not have a down payment requirement. Now, Closing costs. Those are the fees associated with closing any real estate transaction. Even if you were paying cash, there's going to be closing costs. They include title and escrow fees, lender fees, property taxes, and insurance. Okay. So again, in this case, we're not getting super specific. We're just going to use an example of $6,000. So your cash to close. This is the combined total of your down payment and the closing cost. Okay, so you're going to hear that term a lot, cash to close. So you just want to make sure you understand what that term means, because we're just consolidating those two things. So again, in this example, the purchase price is $350,000, your down payment is $10,500, and let's say your closing costs are $6,000. So therefore, your cash to close, right? There's that term again, is $16,500. That's the amount of money that it would take to close this transaction. Okay, so now you're pre-qualified. Now what? So now you're shopping for homes, right? So based on the parameters of your pre-qualification and the details that you gave your agent regarding the location of the home and the amenities, and your agent's going to start sending you a list of homes that are available in the MLS. Those are actual homes that are listed, okay? So they're going to send you active listings. So let's say you find a home that you like. You guys find a home, you've already taken a look at it, and you're like, I want to buy this house. So now you submit an offer and negotiate, right? So you found a home you like. Your agent and your loan officer are going to help you discuss your offer strategy. In a competitive market, it's important to talk to both, not just the agent, but also your loan officer, because there might be some things that we can do to help the loan and to help present your offer to the sellers to make it a much more palatable offer, something that they're going to be willing to accept above all the other offers. Okay, so in some cases, your loan officer may be able to offer you rates that will include some credit towards your closing costs. So make sure you ask about those options. They're going to vary based on current market conditions and the programs. So I'm not saying that everybody's going to be able to give you credit. It's called lender credit, and the lender credit can be used to cover some of your closing costs. It cannot be used towards your down payment. That always have to come from you, the borrower. But keep in mind, sometimes if your DTI, your debt to income, allows it, if you have enough income and you're still qualified for the payment, again, the loan officer may be able to offer you a rate that's maybe slightly higher and maybe give you like $500 or $1,000, in some cases even up to $6,000 towards closing costs. Make sure you ask whoever you're working with about those options. Now, let's say you submit the offer, your contract gets accepted. So now your contract's accepted, you guys negotiated what you wanted, the price, all that good stuff. Now it's time to open escrow. Opening escrow is where you're going to give your earnest money deposit. Okay, it's a very common term, and this is part of the negotiation. I've seen escrow opened with as little as $500. In some cases, what they ask for is 1% of the purchase price. So if you were buying a home of $350,000, they might ask you for $3,500 as the earnest money deposit. Right? So your earnest money deposit counts towards your total cash to close. So remember, we talked about the cash to close, which is basically your down payment plus your closing costs. So whatever you do put as the earnest money, it's just going to bring the cash to close less at closing, right? So the more you give up front, then the less you're going to bring in at closing. Now, at this time, almost simultaneously, you're going to talk to your agent and you're going to order the inspection, right? Or you can waive it. If you find a house that maybe has been built recently and you're confident that you're good to go, you can actually waive the inspection. It is not required. So a home inspection is not required, but it's recommended. You know, buying a house is probably the most expensive purchase that we make in our lifetime. So it is very recommended that you get an inspection, because inspection is going to look at a lot of things. Now, this is typically done within the first days of the contract. Again, unless you waive it, you can actually put that in your offer, and if you find a really good home that you're really comfortable with, you can put that in your offer to the seller and say, look, I'm waiving my inspection period, which means that you're probably going to close faster and you're not going to ask the seller to fix a bunch of stuff that they might not want to fix, right? Because you're waiving it. The average cost is 3 to 500, right? So this depends on obviously the type of report and the location and the size of the property. Normally, your agent's going to know somebody, right? So a licensed home inspector is going to go inspect the home, including plumbing, electrical, roof, foundation, their overall condition of the home. Now, once you receive the inspection report, you're going to review it with your agent. That's going to list any defects or anything that the home has. At this point, you as the buyer have the right to ask the seller to fix any issues that may have been discovered during the inspection. Now again, you're simply asking. Nothing is really forcing the seller to fix anything that you're asking for. You're simply making a request. So this is almost like a counteroffer, and your agent will help do that with you. So the seller may agree to your request. They might say, you know what, that's fine, we'll take care of it, right? Or they might just come back and offer you seller credit instead of taking the repairs, right? So instead of, let's say something came in, you asked for them to fix something. They can either say, yeah, we'll take care of it, we'll fix it before closing. Or they might say, you know what, we'll just, we'll give you $3,000 towards closing costs. Or they can say, we'll lower the price by $5,000, right? Those are all things that can happen. And it's up to you whether you want to accept that or not. Because the seller could also respond and say, you know what, you're going to buy this house as is. Like, I understand, but unfortunately, it's either as is or don't take it at all. So at this point, if there is something that comes up with the inspection, you do have the right to cancel if they choose not to fix anything, and you can get your earnest money back, right? This is why it's important to discuss this with your agent if you're going to waive it, because if you waive it, then there is no inspection, right? And you won't find out. So it's up to you whether you want to move forward with the purchase as is. Now, during this whole time, the file goes into underwriting. So again, a lot of these steps kind of like fall in, you know, not just one after another, but a lot of them happen simultaneously. So think of the underwriting department as a verifications department, right? Basically, a licensed underwriter is going to review your file to make sure that it meets all the underwriting guidelines and income. So in the beginning of the process, when we're going over the pre-qualification, right, I might have asked for pay stubs, bank statements, W-2s, tax returns if you're self-employed, all that good stuff. Because a lot of stuff that I do up front is a lot of what the underwriter is going to request at underwriting. And I do a lot of this up front for you guys so that we can have a smooth transaction and we don't run into problems or anything while we're in underwriting. Okay, so at this stage, the underwriter may request additional information that they need to clarify if they have any questions. So once they're reviewing everything, something comes up, or you know they need just a little bit more clear of an explanation. A lot of times it's just, hey, letter of explanation for this transaction that we see in your bank account. Maybe they think it's another automatic payment that didn't show up on the credit report, right? So a lot of times it's just simple stuff and we take care of it. They're going to call your employers for an employment verification, right? So they also run additional reports to make sure that there is no additional debts or additional owned properties that weren't disclosed in the application. You know, so there's a lot of things when your application, there's a lot of questions that we ask. Again, all this comes from the fact that we have to verify your debt to income. We have to make sure that any liability you have, we're reporting. A couple things that maybe don't show up on the credit report that you may not have thought of. Maybe your loan officer hasn't even asked you. So here they are. Child support. It's important to let us know if you have child support. There's a couple places that we might see child support. If we don't see it on the credit, we're going to see it on the bank statement. If you're paying it, it's going out. And we might see it on your pay stubs if it's being garnished by the employer, right? Another one would be like timeshares. Timeshares typically do not show up on the credit report. But where the underwriter will see that is on your bank statements. If we submit bank statements and we always ask for 2 months, they're always going to ask for the most 2 recent months of bank statements, and they see that the same payment's coming out, they're going to ask what that is. If that ends up being a timeshare and you did not tell your loan officer up front, we now have to add that to the DTI because it is a financial obligation. So we have to go back and we have to add it to the debt to income ratio, and hopefully that we weren't at the limit like we saw in the other example where that example did not qualify. Okay, so those are just some examples of things that may come up that are not on the credit bureau that you're still financially responsible for. The next step, order the appraisal, right? So even though I put this as the next step, again, most of the stuff all happens simultaneously. If you choose to waive the inspection, then we might go straight for the appraisal. Okay, so even though we don't have an inspection, we might go straight for the appraisal. Typically, if you do ask for the inspection, we will wait for the inspection report to come back to make sure that you're not going to request anything, just to make sure there's no major problems with the home, because we definitely don't want to order an appraisal if you're going to cancel the transaction, because this is going to be money out of your pocket. So the appraisal is very similar to the inspection. A licensed appraiser goes to the home, visits, and they perform their own inspection. Now, the cost is going to vary based on same location, availability, and where the home is located. So typical appraisal in Arizona can be between $595 to maybe $800. The purpose of the inspection is to make sure the home meets what's called the minimum property requirements. So basically, the home must be livable, right? And it has to be a safe environment. So FHA, VA, conventional, USDA, they all have similar requirements, but yet each one requires a specific report for that loan, right? So when we order an appraisal for FHA, it's different than ordering one for VA. It's different than ordering one for conventional, and it's different than USDA. Each one's it's essentially the same thing, but they have their unique little things. Like conventional is probably, when it comes to appraisals, a little bit more relaxed than the rest of them. FHA, VA, they're really sticklers on stuff like peeling paint, water stains. Water stain is important because that could be linked to mold, right? But it all comes down to safety and livable, right? It can't be, when you're buying a primary purchase, especially if you go into FHA or any of the government loans, it can't be a huge fixer-upper, right? It can't be something that's got all kinds of broken windows and it's missing doors. And even if you say, no, that's okay, I'll take care of it, it won't pass the appraisal, right? So make sure you talk to your LO about that. There's different loans. We're not going to get into those specifics, but please ask, if you want more detail. So FHA has like a renovation loan, right? That's different. You can use a renovation loan to purchase or to when you refinance and you want to renovate your own home. That's different, and that's, we'll probably get into a different class on those. So for VA appraisals, the cost is determined by the Veterans Administration, and it varies by region. So here in Arizona, the cost for a VA appraisal is $650. That's the base cost. That's not asking the appraiser to rush, because they can add additional fees if you want it even faster than their normal turn times. Now, let's say underwriting is complete. So again, sometimes this happens all at once, one after another, but essentially these are the steps. So now your underwriting is complete. So, now your LO and his team may have asked for additional documentation, right? I asked for everything up front, and then we went to underwriting. They came back with a couple things. I said, hey, I need this, that. You provided to us, and we submitted. So now that we provided everything that the underwriter has asked for, the underwriting has been completed, the process is completed, and a lot of times this can happen before the appraisal report comes back. So if so, then that's when we can schedule the closing, is as soon as the appraisal comes back, if that actually ends up the last thing that we're waiting for. All right, so now let's talk about that appraisal. So it's important that the report comes back as is and at value, okay? Those are two very important terms. So if the report comes back at value, that basically means that if you're buying a house for $350,000, the appraised value, the appraiser said that it's $350,000 or more. It's okay if it goes up, not okay if it goes down. Now, if the report comes back as is, that means that the appraiser did not see anything wrong with the condition of the home, and there's no repairs needed. So that's what we want. We want it to come back as is and at value. If the appraised value is less than the purchase price, okay, then either you, the borrower, need to come in with the difference. So let's say that you're buying the house for $350,000, and the appraised value says it's $340,000. That's a $10,000 difference. So there's two things: either the seller needs to lower the purchase price to $340,000, or if the seller says nope, that's my price and I'm sticking to it, then you, the buyer, need to come in with an additional $10,000 to cover that difference. Okay. If the report comes back subject to, that basically means that it's subject to some sort of repair, right? Now, if it's on the appraisal, even if you and the seller, you, the buyer, and the seller agree to fix this after closing, or they're like, yeah, we'll just give you back, if you guys agree after, if it's on the appraisal, it has to be taken care of before it funds. The lender will not release the funds if there is something pending on the appraisal. Okay, that's what subject to means. We don't want subject to any repairs. Now, once all that's complete, maybe the appraisal report came back and we got clear to close or vice versa. This clear to close, we call that CTC for short. Okay, so at this point, everything that the underwriter has requested has been turned in and verified, and the appraisal report has been completed and approved. Our team is going to balance the file with the escrow company to determine the final cash to close and prep your final docs. So in the very beginning, we're going to give you a loan estimate, which is estimated fees. When we get the clear to close and our team starts to balance, that means we're getting actual invoices, right? So the actual invoice for the appraisal, the actual invoice for the credit report. We get all the invoices together and they get audited to make sure that you're not paying twice for something, right? Where if you've already paid for it, we're going to take it out as already paid. And we call it POC, paid outside of closing. So we basically balance everything out, make sure that you're only getting charged the appropriate fees, nothing more, nothing less, and then we prepare the final docs. Okay, so once we balance, now we can schedule the signing with the escrow company. Once the final docs are ready, escrow company is going to reach out to you. They're going to call you. They're going to set an appointment of when you can sign, all parties involved, and they're going to let you know your final cash to close. Right? You guys remember that term, cash to close? Basically just your down payment and your closing cost all put together. That's going to be your final cash to close. Now, the loan funds, right? So once the signed docs have been uploaded to the lender, the escrow company is going to request the wire, and the lender is going to release the funds. So typically, either you go to the escrow office and sign your documents there, or they might send a notary to you, right? So basically, that notary's got to take all that paperwork, take it right back, or the next day, depending on when you guys signed. But they take the docs back to the escrow company, and they will scan them all in and send them to the lender. They're going to do one final check to make sure that we dotted our I's and crossed our T's, got all the signatures where they need to be. So once the lender reviews docs, and this happens pretty quickly because in a lot of states, the loan can fund the same day or at least 24 hours after you signed, right? But once they've checked everything, they release the funds, right? After the loan funds, we record with the county. So after the loan funds comes the recording. This is where the escrow company is going to record the transaction with the county. Once it is recorded with the county, you are officially homeowners, right? And that's when you get the keys. So congratulations, you're a homeowner. Not as hard as you thought, right? So once you're officially the homeowner, your real estate agent is going to contact you and deliver your keys, right? So I'm sure you guys are going to be in contact throughout the whole process, but basically once you record, you're officially the homeowner. That's when your agent's going to reach out to you, probably meet at the property, and that's when you can actually get the keys. All right, so again, my name's Arturo Viramontes. I am a senior mortgage advisor for Amerifund Home Loans. I hope you guys liked this presentation. I hope you guys got a lot of education out of it. If you have any questions or anything, please reach out. You can either reach me on my cell, 602-549-9239. If you have any additional questions that we did not cover, or you wanted more specific information on the process, on something you saw, okay, you can email me as well. Let me know any questions you have. Again, thank you so much for reaching out to me. I really, really look forward to working with you. And based on your specific scenario, I will give you examples and information, and I will let you decide on which loan is going to work best for you. Okay, that's our job. We're going to go over the different options once we get your application and all of your docs in for review, and I'll share with you the different options for each loan. But this is basically the steps of the home buying process. Okay, so let me know if you have any questions. Click on the link that goes straight to my application, so you can fill out the application. You can submit your docs through there as well, or you can always email me your documents at the email. Again, thanks so much, and I look forward to working with you guys.